Everyone's watching the AI wave and cheering on new highs, but today we dig into what's actually powering this rally, what's being ignored, and why it matters. Let's break it down. So overall, stocks have been ignoring these tariff threats coming from Trump, thinking that he's bluffing, but today that trade hasn't worked out too well. We got some news that we'll get into later on in this video, and last night it caused stocks to really fall down, and today they opened a little bit lower and continue to fall throughout the day. 22V Research argued that the reaction that we've seen could have been much bigger, but there's this view that Trump is being impatient and getting more aggressive to speed up potential deals. He's delayed tariffs for months now, though, so I'm not sure how impatient he can be viewed for his recent actions. There has been a belief, though, that these tariff negotiations will take a lot longer than expected, even taking as much as years to finally come up to the final conclusion of what we'll see regarding these tariffs. 22V Research also shared that there's this assumption that the International Emergency Economic Powers Act related tariffs won't hold up. So they're seeing that they'll be shot down, and also that tariff rates will settle lower after these negotiations take place. Now, if these tariffs don't hold up and let's say they just disappear, Houston, we got a problem. Because the government needs the tariff revenue for the tax and spending bill that was signed into law July 4th of this year. And without tariffs, there will be more need to issue treasuries to continue paying the bills. So what does that sound like? Higher treasury yields and possibly lower stocks if that's the case. Now, let's go back in time a little bit and look back at April 2nd stocks. And what we see, actually, let's go back to February. I believe it was like February 18th, 19th. Yeah, so that's around when Trump started discussing the idea of tariffs. And then the market kind of like, what can happen out of that? So then April 2nd came, and oh my gosh, they're like worse than expected. And then boom, we kind of fell off of a cliff, and then we bottomed out. And since then, we've climbed back up. And as the tariff news has resurfaced, the market's really discounted what can happen, and we've powered on to new highs. But now we've just completely, in the market, have been ignoring all of the latest headlines, and it makes sense. The tariffs haven't really impacted the economic data too much, and jobs have held up, all helping delay the idea of this recession that a lot of people were expecting was near. Now, depending on the industry, demand has also held up, highlighting that expectations of earnings beats may come to fruition, and mega caps haven't really been impacted by the tariffs either. But this is where the risk starts to happen, because narrow market breadth heading into earnings could be concerning, because remember, I said depending on the industry. So it could be concerning with impacts from tariffs and inflation, leading analysts to expect profit growth to slow sharply from Q1. And it's also very, very, very unlikely that, say, this August 1st deadline comes and then tariffs just go away. All right, we got the tariff rates August 1st, no more negotiations, and now all of the uncertainty's gone. I think that's very unlikely to happen. Jamie Dimon again came out and warned. This isn't the first time that he's warned, but he's warning complacency around tariffs, rate cuts, and stocks where they're at. And what he sees is possibilities of higher rates from the Fed, saying that if the market sees a 20% chance of this happening, he's closer to 40 to 50%. So I wonder what kind of data he's seeing, or if he's hearing stuff from his connections, because Jamie Dimon, imagine the type of people he has access to and the type of data he's able to see. So maybe he's seeing tariffs actually showing up meaningfully in the data, and causes rising inflation, to where while the economy and the job market's holding up, the Fed actually needs to dampen down inflation by possibly raising rates. And there's not much signs of the job market deteriorating, but today the State Department's announced that they're letting go 1,300 employees, and then Microsoft laying off 9,000. There's signs of the job market weakening, but overall it's held up pretty well. It's just companies aren't hiring, and college graduates are having a hard time finding jobs. So it's really jobless people having a tough time, but people with jobs are holding up pretty well. But it's inflation that the Fed and Jamie Dimon and some of these analysts are seeing the problem with it potentially being sticky. And we'll get a peek at that on Tuesday when we get this CPI data from the BLS, the Bureau of Labor Statistics. And what we're expecting is for June, we're expecting core CPI year over year to come in at 3%, up from 2.8% the month prior. And this isn't so much what the Fed watches. It does play into that data and what to expect to happen. And it seems like the common trend is up further away from the Fed's 2% target. So this could play into PCE coming in a little bit more hot. And then July, a lot of people don't think July's there's a couple Fed members that support cutting in July, but overall, the broader market expects July to completely be off of the table for rate cuts, and that September is the month to watch. But if, like I said, CPI and inflation start coming in more hot, that could walk back September's meeting and rate cuts could be off of the table. But with stocks holding up pretty well, that just goes to Trump having more leverage in his negotiations with trading partners, and he can spend financial market capital with stocks when these stocks are up and extract concessions from these trading partners. This was a great point of view from Global Data and TS Lombard, pointing out that the opposite end of the taco trade should be considered because things don't just go up in a straight line. Now, let's look at this. So there's this report from Goldman, and what Goldman point out is that inflation from tariffs and the tax and spending bill could continue creating this stagflationary environment. Those are all of the ingredients we need, while a potential slowdown in the economy, because people expect the economy to slow down later on this year, although that's not the case right now. It's an expectation that's widely held right now, along with inflation. So stagnant growth and higher prices, which makes it hard for the Fed, which even goes into the higher for longer rates or even higher rates that Jamie Dimon's warning of. The third being even weaker dollar, which goes into purchasing power, making it hard for Americans because now we're able to purchase less. The purchase power goes down for people who transact in the US dollar. And then that goes back to playing into inflation, which that's allowed. Look at this chart right here. I'm pulling it up. That has allowed Bitcoin to really thrive. So tread cautiously in this market. Despite all of the all-time highs, we see Bitcoin has really spiked today, reaching almost 119,000, which is huge. We're making milestones, climbing closer to 120,000. They say this year we could possibly see 150,000 or even as high as 200,000. So we'll see what happens, but it's making history. And a lot of these Bitcoin performing the way it has, it's due to inflows into Bitcoin ETFs with inflows of 1.18 billion yesterday, and net inflows for 2025 as a whole being estimated around 51 billion. And I'd imagine this number is even higher today with all of the euphoria around it. We haven't given back too much today. I mean, we bounced off of the 119, but we're still at 117.5 as far as the price goes. And then not even just to go into that, rate cuts or the possibility of rate cuts are making more people support and happy or optimistic about cryptocurrency and even more risk on plays. And then the regulatory mess has all helped too, because with the US dollar going down, people are getting rid of their US dollar and allocating more to Bitcoin. And think about the US dollar as a global reserve currency. When the US dollar is expected to continue falling and this uncertainties continue to prolong or be extended, it really shakes a lot of people out of the willingness to just hold the US dollar, which, I mean, I guess you could hold the euro, that's another, or the BRICS currency. Bitcoin is more so what a lot of people are expecting to one day be a reserve currency. So we'll see what happens with that. And gold has reached new all-time highs. Bitcoin just plays into the digital gold narrative, whether or not that's the case, but you can see it's reaching new all-time highs and it's really getting a spike these days. And then on top of that, there's been some regulatory support for crypto with the Genius Act passing, allowing crypto to be more insulated into the economy. So we'll just keep on watching this. Now let's look at another chart. This chart measures market volatility. We're looking at the VIX. And the VIX spiked, aligning with the caution, but it's still pretty low, and calm is what that is. But how long do we stay at these calm levels? We're still below 17, still under 20. Wow, what is my chart doing? It's like tripping. All right, let's do this. Let's put it on the 5-minute chart and then we can see. Over here, though, you can see it's at 1640. And when the reading is below 20, that's what you'd call a more normal reading, which a normal reading's more normal. But once we're like we're still pretty calm, right? I'm just going to zoom out. I don't know why this is looking like this. Maybe there's just, there we go. You can see it now. 640. So we did get a spike, and I'd imagine this is based on the news. Like, whoa, like Trump's maybe putting his foot down, because a lot of people point to this taco trade and this bluff. But if that's not the case, do we stay at these levels if it could get worse and then we see like a Liberation Day 2.0, which it seems like that's where we're going. But let's talk about why stocks dropped a little bit and the VIX spiking just a little bit. I bet you can guess why, what, and who. And a lot of people are probably guessing right now. Ding, 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 ding. Trump and tariffs and negotiations and uncertainty. So what we got is Trump announced that Canada's tariff rate will increase to 35% starting next month on that August 1st deadline, which is up from the 25% we were at, mainly due to this fentanyl war that he's got. Still, though, 50% on steel and aluminum. Energy and fertilizer will only get 10% tariffs. And then note that Canadian goods that comply with the US, Mexico, and Canada free trade agreement will still be exempt from these tariffs, like cars, autos, lumber, and a few other goods. And because there's so many countries, Trump says that he's planning a blanket levy of about 15 to 20% on countries who haven't gotten a letter yet, higher than that 10% baseline. Note that. So I think that's where all of this, could this get worse is coming from. But there's also talk that the European Union deal is near, which makes up 27 nations and is a huge trading partner. 27 nations, that's huge. And the public has been waiting to hear more news on that specific deal and China. So that's what we got today, y'all. Momentum gets attention, but understanding gets results. If you want to stay updated, don't just read these titles to these headlines and react. You want to read between the lines, understand what's going on, stay updated, and allow the others to chase the noise and FOMO, fear of missing out, and make questionable decisions in a questionable time. So I'll catch you in the next video. I invite you to join me back. Hope your weekend's great. We made it, y'all, and I'll see you in the next one. Peace out.